Thanks, Kath. So just by way of introduction, I'm Bea O'Carroll. I am one of the co-founders and the COO of Reciprocity Trading. We are a boutique OTC desk headquartered in New York City. Prior to founding Reciprocity Trading, I worked at Circle on the OTC desk, and that is where I had the wonderful pleasure of meeting Mr. Proudman, whom I will let introduce himself now.
Perfect. So I'm Jesse Proudman, longtime entrepreneur, started my last company in 2003, exited it to IBM in 2015, spent about 2.5 years at IBM as a distinguished engineer working on IBM Cloud and then working with IBM Ventures to launch a blockchain accelerator. The funding got cut for that program in 2017, decided I wanted to do something in this space, and so founded Strix Leviathan with Sadie Rainey in January of 2018. Strix Leviathan is there's sort of two sides to the company. On one side, we have built and operate a pretty sophisticated, probably the most sophisticated portfolio management order execution system in the space. And the second side, we have a quantitative hedge fund that uses that software to trade a pooled investment vehicle.
So I was super excited when Sadie and I were talking that you were going to join us tonight, Jesse, because you and I know each other for a while, and there's been an awful lot. In some ways, there's been a ton that's changed since we first met 2.5 years ago, and there's a lot of stuff that's still the same. So how about starting with kind of current events and the landscape today? We've had a lot of news recently with like Genesis acquiring Volt, Coinbase acquiring Tagomi, and just kind of bundling of services on the trading side of the business. How do you think about that from the Strix Leviathan kind of quant trading perspective? Do you think that like there's enough business? Like, do you think we're ready for it? Like, what are the sort of factors that go into your decision-making process when you're looking for trading partners?
Yeah, so there's two sides to this that I think I want to answer. So the first is really the business side. This entire industry really reminds me of my last company in terms of its evolution and where it sort of sits in sort of the adoption landscape. So you have 2017, which drives all kinds of entrepreneurial interest in the space and drives all kinds of investment into the space. And so you end up with companies like Tagomi, who had an incredible founding team and raised a very significant sum of money. They launch, they build their product, and then you very quickly realize there's not enough customers there to support getting revenue to a point where you can go raise a Series B. And the burn rates are so high, a lot of these companies, that because they're trying to grow and build quickly, that it becomes unsustainable. And so that's sort of one of the latest examples, I think. And I think the Coinbase acquisition, certainly it is to help build out Coinbase's product suite, but it's also sort of a safe landing for Tagomi within the space. And I think we're going to see a lot more of that. There's a lot of competition with companies all effectively doing very similar things without a lot of differentiation and with significant investor capital into them, right? So Series Bs are going to be you already look, the broader venture landscape is sort of in a period of pause or contraction. Valuations are coming down. Valuations in this space were already very rich to begin with as a function of 2017. Sort of 18 and 19. 18 certainly helps bring them down a bit, but they're not necessarily where they need to be. So I think we're going to see more of that occur. This rush to prime brokerage is really fascinating to me, and the fact that it's all happening kind of simultaneously between BitGo and Coinbase and Genesis. It's an interesting time. You also have companies like Falcon X, who recently raised $17 million. Like, everybody's trying to do a similar thing. And the reality here is that we have liquidity fractured across hundreds of exchanges. We have dozens of OTC desks that effectively trade largely amongst each other and amongst these exchanges. And sort of best execution is really dependent on who those counterparties are and what's happening in the market at any given time. Like, I think people get fooled by going on CoinMarketCap and looking at daily volumes of traded capital. Like, there is not as much liquidity in this space as I think people really believe there is, and we see that amongst all of these counterparties. So from our perspective, we like to work with entities. So we do everything. All of our trading is done OTC. I'll start there. All of the OTC trading we do is done through electronic APIs. So we have moved entirely off of Skype-based interactions. And so the counterparties that we work with, effectively, the differentiation has to be price. It has to be sort of consistency of price. Like we will win, or counterparties we work with will win based on the quotes they give us, because that's how the system we've built is developed. And so where sort of 2 years ago, relationship was really important, and being chummy with your counterparties was great. Like, I think that's still important, but that doesn't necessarily win bids anymore. So this bundling effort to me feels like a way to try to build additional differentiation. You're seeing that a lot on the lending side. That's been the first thing that started to get bundled. The interesting thing to me is that there doesn't, the same liquidity problem, there doesn't seem to be much liquidity in the lending space outside of a couple specific lenders. And so I think a lot of these folks that are purporting to have lending desks, I mean, they're all going back to the same liquidity sources at the end of the day. And so it doesn't really help. So I guess I see it as a way to try to, these companies are trying to differentiate themselves in the midst of a crowded landscape. But at the end of the day, most market participants are looking for best execution, whether that's best price on borrows or yield, or they're looking for best execution on the actual orders they're getting. And sort of bundling things together doesn't necessarily get me that.
So it sounds like there's a couple of issues going on in there. Like, you've got liquidity, you've got connectivity. I mean, I guess from when you and I started trading when we were at Circle, and most people were on Skype, and now you've moved completely onto API platforms. I would love to know, like, how easy has it been for you to find counterparties that you can trade with via API? Because as far as like when we started talking about what's changed recently with consolidation and what sort of hasn't changed, at least from our perspective, there's still a number of people that we've talked to that are like, yeah, I don't want to log into a platform. I really just want to be able to pick up the phone or get on Telegram and chat with you. What are your biggest pain points? Is it like being able to efficiently and effectively connect electronically? Is it more the fractured liquidity that you mentioned? Is it best execution? Is it like regulatory issues? Like, from your perspective, what are like your three biggest challenges for Strix?
Yeah, I mean, this was a shock to me 2.5 years ago when we got started in the space. So how OTC trading worked 2.5 years ago, you would get into Skype rooms with 3 or 4 different counterparties, and you'd say, I want to buy $500,000, $1 million worth of Bitcoin. And then you'd be sitting there watching little dots indicate that somebody's typing, waiting for you to get the quote back. And then so you get the quote back from somebody, you'd be waiting on the quotes from the other counterparties. By the time you get all 3, the first price is invalid. You do this for 5 or 10 minutes. It was a joke. It's a joke, and millions of dollars is traded this way, or hundreds of millions of dollars is traded that way. And so our first, like, we realized this was a joke and it was inefficient. And so the first thing we tried to do is, like, can we build a Skype bot that basically emulates a trader on our side and goes and talks to these desks for us? Skype wasn't a great mechanism to do that, and we started to go down the route of doing it in Telegram. It's just like, you shouldn't have to do that. It's a travesty. At the end of 18, we started to see counterparties begin to debut streaming quote systems. And the issue again for us was that we want to trade with multiple counterparties. We don't want to trade with a single counterparty. And so having one API doesn't really do it for us. And so we definitely integrated with that first API, and it was interesting, and we sort of used it in some form or another. But it wasn't until sort of mid 2019 that we started to get like 4 or 5 counterparties that all had APIs. And then you run into the classic crypto problem where every API is different and behavior is different. And this existed. I mean, this is the exchange problem, right? Every exchange has a different API. They all have different rules. They all have different order types. They all have different decimal rounding rules. And I mean, it's broken. And it's the same on the OTC side. All of the APIs work structurally differently. Some stream you prices, some you request them. The expirations are all different. The formats are all different. So we spent a bunch of time in 2019 building this abstraction layer that effectively allows us to take any feed from any desk and plug it in as if it was the same thing. And that's been really helpful. So that was kind of mid 2018. And then we've started to see over the last 3 or 4 months in 2020, sort of this huge surge in new desks, or we'll call them liquidity providers at this point in time, that all have sort of liquidity interfaces. And so now it's become sort of, I'm inundated on LinkedIn. So now it's become this effort of like, what is the benefit for us for adding another counterparty versus the complexity of having another entity to deal with. So we've sort of gone from not having enough to now having too many. And then once you have too many, settlement becomes the next big issue.
Yeah. So I guess on that point, like not really settlement, but more on too many or too few, you and I can't trade because you're in Washington and we're still kind of going through the regulatory situation. And I think in general, at least historically, Washington has kind of been a close second to New York in terms of the level of friction in trying to get a crypto business started. How have you, like, what's been your experience with that? Is that something that like is a problem for many people? Do you think people are aware of it? Like, what's your perspective? Like, what kind of challenges being an actively managed crypto fund out of Washington State have you faced?
Yeah. Hold on, I think I just lost audio here. So Washington, if I knew what I know about Washington now 2.5 years ago, I probably would have moved and or not started this company. Or both. Washington is a challenge. So Washington has a regulatory agency called the DFI that oversees investment managers as well as a number of other entities. In almost any other state, we're a hedge fund. We're we started off as a 3C1 pooled investment hedge fund. And in almost any other state, that would mean that we have an exemption against sort of traditional registered investment advisor security laws. Washington State effectively has laws where if you are trading securities on behalf of accredited investors, you are subject to the jurisdiction of the DFI. And so when we started this business, Perkins Coie took the perspective that the assets we were trading were not securities, and thus we were not under the jurisdiction of DFI. The DFI disagreed with that position, which I get, like I understand. And we went back and forth. There's not, I mean, this is the challenging thing. We're all operating in this incredibly opaque regulatory landscape. So the DFI says you're trading securities, but they won't say what assets they deemed in this space or in the list of assets that we trade that they actually deem to be securities. So it makes it's untenable and impossible. So we ended up converting to a 3C7 fund just to avoid the issue. So that means all the accredited investors that were in our fund, we had to remove, and which is pretty ironic. So as an accredited investor in Washington State, you can make an equity investment in my business. In fact, a number of the accredited investors that were in the fund are equity owners of our company, right? So you can make an illiquid, speculative equity investment in a business. You can go on Coinbase or Bittrex, which are both licensed as with money transmitter licenses from the Washington State DFI, and you can go buy these assets directly. But you cannot make an investment into a pooled investment vehicle that is designed to de-risk your exposure to the space. Like it's illogical. So we ended up getting connected with Cole Friedman, who's a law firm in San Francisco, and we've been working with them and the DFI really to try to educate around these policies. And I will say in the research that we've been doing, like the SEC, most of the issue here is around, like we would love to be a registered investment advisor. Like we've been trying to do that from day one. The issue gets into all these nuanced laws, and a lot of it's around custody. So as a registered investment advisor, you are legally required to store all of your assets in a qualified custodian. Obviously, qualified custodians didn't even exist in this space a number of years ago. Sort of now they do, but the asset support is not particularly broad. And so there's all these limitations that get imposed on your business as a function of that if we were in any other state wouldn't be an issue. So we're in this education campaign, and it's great. The DFI has been wonderful. They've been listening and asking great questions, and our hope is we can help kind of change and adapt and update some of the policies and how they apply to the space. But yeah, Washington is, I mean, it's a unique state, and New York is very similar in at least in how they restrict access to the space. And it's unfortunate. I think at the end of the day, what it means is that companies that really are trying to do the right thing are the ones that suffer. Like we've tried to do the right thing from day one, and it's hurt our business. And if we had just sort of ignored all the rules like many other market participants do, or gone offshore, we would arguably have been better off from a business perspective. But that's not who we are. Like we're trying to do the right thing. So it's an unfortunate reality of operating on the bleeding edge.
Good to hear that you're making progress, though, right? That there is a way forward. If it's like a Spartan race of obstacles, but at least like there is a path somewhere, right?
Well, it's always great when a regulator is willing to listen, like and actually ask questions. I mean, they're always willing to listen. It's asking questions, which means they heard you, and they're thinking about it. And so we're feeling very encouraged. We'll see where it ends up. But yeah, it's been more of a challenge than we had anticipated.
So last question, lightning round. You knew it was coming. A lot of uncertainty cooking at the moment, all kinds of pandemics and social unrest. How are you thinking about that? Like, what does the rest of 2020 kind of look for you? How's it affecting the decisions you're making with your business, if any?
Yeah, I mean, that's the wonderful thing about how we've built this business is that we just let the algorithms decide. So from a traditional, I have limited mental capacity and I spend it all in the crypto market. So I can't pay attention to what's going on in the traditional financial realm. We certainly, I think we're in Seattle. My wife's family is from Taiwan. So I feel like we saw the pandemic side earlier than many in our social circles. We had a blog post up in early March that was talking about what was coming, and the top of the title was "A Tsunami is Not Just a Wave," and so it definitely has played out much as I expected. The sort of the response over the last couple of months has not played out as I expected. So I've been pretty surprised with the behavior of the stock market, although sort of I think you can never count out the Fed printing unlimited money and being able to buy whatever they want, right? It's you don't know what's going to happen when that starts. So, but I can't pay attention to the traditional equities. I have no idea what's going to happen there. From a more broader sort of social perspective, certainly the events of the last 12 days or so and the Black Lives Matters movement, I think this has been a really fascinating culmination in, or at least escalation, I think, in communal rage across the country. I think you've got 3 months of people stuck at home, stuck on social media, watching these horrific videos of the police with George Floyd over and over and over. And we finally sort of hit people's breaking point. So I think we've got, I think we're at the very beginning of what's going to happen there over the next couple months or years, hopefully, knock on wood. We obviously need pretty systemic change in this country. And then in crypto, to close out my sort of forecast, I think this is an industry that is built so much on narrative, and the narrative for much of the last 6 months has been the halving and the stock to flow model, and sort of the conclusion that price will go up as a function of reduction in chain emissions. I think that is entirely false. And we're working on research right now that we'll have published in the next week or two on that. I think at the end of the day, all of the assets in this space have arguably zero fundamental value. The fundamental value that does exist is certainly not shared amongst market participants. Like if I have a valuation model for Bitcoin, it's going to be a different model than you have or that anybody else has. And the value that exists here it's driven by speculators. I mean, we can pretend it's different, but at the end of the day, that's our belief that this is an entirely speculative industry, and it's a speculative industry that sits outside the bounds of sort of the traditional financial world. And that's not a bad thing. I think it's a great thing for all of us. It's great to have financial instruments with liquidity and all of the tools and technology that we've built outside of the bounds of the traditional financial world. But they're speculative instruments. So narrative in a speculative world, narratives become incredibly important. And sort of those narratives have the power to become true, whether or not they actually were true, or whether or not they actually had predictive power, sort of in hindsight. So, we don't think stock to flow is a valid model. We don't think it predicts price. We think there is a lot of uncertainty over the next 6 months as miners sort of figure out what their economic landscape looks like in the midst of sort of this new reality. Their income, the mining industry, and this is the thing people forget, we've gone through 2 halvings prior. Neither of those halvings, we had industrialized mining on this scale, right? There is hundreds of millions, if not billions of dollars invested in data centers and infrastructure. And a lot of that is then held in native coin and borrowed against. And a lot of these businesses are dependent on the price going up to stay solvent. And so we don't know. We just don't know what this is going to look like. You can't use a sample set of 2 historically to predict the future. I would love for Bitcoin to be $228,000, like Stock to Flow X says. But just because we will it doesn't make it that way. So at the end of the day, we have to think through, where is new money coming into the space from, and why are those participants entering the space? And until we really see a surge in net new capital, like Paul Tudor Jones, it's great to see those types of articles written, right? But he's buying cash settled futures. He's not buying spot coin. So that's not net new money entering the space.